Good afternoon, and welcome to the Jack and Bill Show, the April Fool's Day edition of the April 1, 2022 Jack and Bill Show. Well, I started off this morning, Bill, and my wife was telling me that I needed to go get my hair cut. Come downtown with me to get my hair cut.
Are you sure?
Huh?
Are you sure you want to tell the story?
She's sitting out there, and so I grabbed the my buzzer thing, trimmers, walked out into the backyard, and came back in. And she said, "I was afraid you were going to do that, but I look beautiful today, don't I?" So no, I could have said, "Well, I came out of hair and makeup, and I didn't have anything upstairs." So, so, but today is.
Why are we moving on? Let's talk about this some more.
Welcome back,
Thank you.
William. Back from double knee replacement. We had some clients that sat in your absence, and
they did a fine job.
Made it kind of interesting, to say the least. But you know, today marks another day. It's the start of a new quarter, and it's the end of an old quarter.
Yep.
Or yesterday was, and the Q1 was interesting, to say the least, profoundly volatile. We went through a market correction in all of the major indices, a market correction being defined as a pullback of 10% or more from a previous closing high, and with a bear market being defined as a pullback of 20% or more. So we didn't get into bear market territory like we did. The last one was very quickly with the pandemic, and then very quickly coming out of the bear market with, we had an induced, really an induced recession. And because, you know, all the economies worldwide were shut down.
Kind of like we're having induced inflation.
Really, I agree. We're seeing a lot of that. Well, in the last week, we've had a pretty strong rally. Ended out the quarter yesterday down. S&P 500 year to date for the quarter was down 4.6%. We rallied, call it 1/3% with the major. That's pretty close to what all the major market indices did. Excuse me, today, with the broader market going up significantly more, and some of those type names fared very poorly in Q1. But one of the big stories of the first quarter was what happened in the bond market, and we had the worst quarterly decline, Bill, in the bond market in 40 years. So I looked in today's Wall Street Journal. The Vanguard Total Bond Index was down 6.1% for Q1, and the most commonly quoted index, U.S. Barclays Aggregate, down 5.9%. And you know, that's not a long duration. Long duration bonds were down, you know, more than 10%. And then, you know, I looked at the Dow Jones Industrial Average, which is 30 stocks. 12 of those were up in Q1, with 18 down. Chevron being the best performer, up 38.8%, and Home Depot being the worst performer, down 27.9%. Another huge story, continuation of last year, is the performance of the Dow Jones Commodity Index, closing out Q1 up 24.06%. Natural gas leading the way, up 51.3%. Crude oil up 33.3%. That's after, you know, that's that's crude around $100 a barrel for West Texas Intermediate, down from highs in the 130s just a few weeks ago. So, but still up, more than 100% in the last couple of years, and that's doing a lot of harm at the pump. And this is something that I view as something that's going to continue in the immediate future. Same thing with nat gas. So we had, of course, the two most profound things happening in Q1 is the prospect for much higher interest rates that brought about a lot of volatility in the stock market. And then I think we're like day 36 into Russia's invasion of Ukraine. And that's really, speaking of commodity price inflation, that's thrown a huge wrinkle into, the White House saying that we've got higher oil and gas prices because of Russia, but that's a partial truth. They're shutting off gas supplies to Europe, and then so the U.S. is having to export, and Ukraine is supposed to be planting wheat and barley right about now. I don't think we're going to see that, and I don't think we're going to see. I think roughly a third of the world's wheat and barley crop, a third of the world's exports come from Russia and Ukraine. So you can expect very little from that. We've also got problems with a major drought in California, Arizona, Nevada, parts of Texas, San Joaquin Valley, which produces 15% of the United States vegetables. So we're looking at, we're going to see some food shortages, I'm afraid, this year. So,
well, you're talking about profound changes. I think you cannot say that without also mentioning the inverted yield curve. That has had a profound impact, and it's very talked about in the marketplace because, while it doesn't have to be the case, historically, when you see the yield curve invert, that's a good indicator that we're heading into recession, and it's generally within 2 years of the inversion.
Yeah. I think we inverted last inverted in 2019 briefly. Yeah, so that's I think that just about every tightening cycle, the Fed pushes us. They go too far and push us into inflation, and they're looking at a real dilemma right now, as you know, Bill, with whether to be concerned most about a growing economy or runaway inflation, which most people now, a lot of people have lost respect for the Federal Reserve for, comments like last summer saying that the inflation was transitory. And I think some of it is clearly transitory, and transitory coming from supply chain disruptions from the pandemic and so forth. And you can say some of this is transitory with a war that's hopefully very temporary. But a lot of this stuff, a lot of the inflation that we're seeing is secular, and in fact, very quickly, and this is why the bond market did so poorly in Q1, and why we inverted, is because of the belief that you can look at the 2-year Treasury note yield, as you pointed out in a meeting the other day, climbing to 2.4%. I mean, that's almost the same as a 30-year, long Treasury yielding
2.5.
Yeah, is at roughly 2.5. So that, and just in the last 10 days, I mean, we saw in December of last year, I think the 2-year Treasury note yield was about 0.75%. So very quickly, perceptions have changed. There was a vote with the FOMC at the ending March meeting it was 8-1 vote. Bullard was the one vote that was against a 0.25% increase. He wanted a 0.5% increase, and now there's speculation that they're going to have to do more than essentially going into the meeting. It was looking like we were going to have 0.25% increases with every one of the remaining FOMC meetings, and they're every 6 weeks. So they meet again in May. Now the market is discounting probably 0.5% raise at the next meeting. And that's going to really do some harm to economic growth. And if you think about housing and mortgage rates and everything, many key interest rates tied to the Fed funds rate, which anyway, you've got
a good indicator. You mentioned the 2-year. Yes. If you want a good idea of where the Fed funds rate is projected to be in the future, look at the 2-year Treasury yield. So it's at 2.41%. You can also look at overnight index swaps. The 2-year swap rate is at 2.36. So let's just say 2.4. So that's where the market thinks that the Fed will take the Fed funds rate in the near future. And I'm looking at some data here that the Fed funds implied probability policy rate for July, the end of July, is at 1.6. So just a few months from here in July, the market's expecting that we're going to be up to 1.6, getting towards that 2.4.
okay.
He should be watching the show.
Now, this guy was one of our guests, and he's calling in while we're doing the show. He should know better.
Well, you have your phone ringer on.
You should know better.
So anyway, so that's the direction the Fed funds rate is expected to go. Yeah, the Fed is expected to continue tightening in the face of rising inflation around 8% currently. And the Fed has to do something. Everyone agrees. That's one of the mandates. One of the primary mandates of the Fed is to keep inflation at bay. The Fed's target inflation rate is 2% a year. So clearly we're way above that. The Fed's going to have to do something. And, there's been a debate about whether the Fed will continue to support asset prices by keeping rates low, or will they go ahead and pursue their true mandate of keeping inflation at bay by raising rates. And I think that they're going to prove that they will stick to the true mandate, and it will mean pain for asset prices, because as the Fed raises rates, we can expect that we'll have PE multiple contraction in stocks. And so there's just a lot of things going on that are indicative of us being kind of late cycle, in the economy. We're seeing rates start to move up. The yield curve inverted. The energy sector is doing well. We're seeing stock factors like low volatility and high quality do well and outperforming. So these are just things that kind of paint a picture of where we are right now.
Yeah, I'd like to kick in there, again, talking about the Fed dual mandate. It's roughly 2% inflation. And
that's their internal target.
And for a while, because of the pandemic, due to the pandemic, they decided to not do anything about inflation. And I think for good reason. Although I think most people think they waited way too long. The maximum employment, anytime we're at 5% unemployment or better, we're at full employment.
Yeah, full.
And they've done a good job with that. We're ahead of that. In fact, when you're under that, it's that's actually inflationary, because because for corporations to hire good workers, they're going to have to bid up the price of labor or workers and steal them from other jobs and pay them more money. And we've got a big secular long-term problem with our, really the whole world does demographically, with number of people turning age 50 or age 65 in this country is alarmingly high. But there's been an unwritten mandate too, Bill, and that has been ever since the subprime crisis, to use Fed tactics to keep the stock and bond markets propped up. And so that's going to be interesting. I think in 2022, we're going to find out which mandate is really important.
Well, it's going to be the stated mandate over the unwritten mandate. No question in my mind.
Oh, really?
Really?
Yeah.
They're going to let asset prices suffer as they fight inflation. No question in my mind.
Yeah. I mean, I've got my viewpoint is a little bit different on that. I don't think we get huge volatility with, in fact, I mean, I read a lot of that. I think, I've read both sides, but a lot of people feel like the Fed is trapped. And when the markets start to discount these problems of higher interest rates, which would be the inverse of everything we had with QE helping the markets, that the Fed will backtrack and say, and I mean, they have a history of having done this already since the subprime crisis, that they stop tightening, they ease, go back to zero, and start doing quantitative easing.
That is true, but they also didn't have 8% inflation.
I think this could go out there that, one of the things that we've pointed out in the spreadsheet that you make annually, Bill, is there, this could go along the lines almost like conspiracy theory, but there are a lot of smart people that think that the Fed is intentionally behind the inflation curve because we're at 120% debt to GDP. And if you have 10% inflation for 7 years, that would have the effect of slicing our national debt in half.
Yeah, at the expense of the taxpayers. So, yes, right. That's why it's aptly categorized as conspiratorial.
Well, we're going to see how this plays out. But I don't think that politically, it looks like the Fed has become more and more political. And there's going to be great harm, great political damage done if Jerome Powell and his cronies do the opposite of what the White House wants. And I think 2022 is going to be a year when we find out, are they going to have the strength and resolve to do what Paul Volcker did in the late 70s and early 80s?
Yeah, we'll see. I mean, if the Fed is truly political, as you claim, well, it's in the interests of the administration to rein in inflation. That would be the political mandate.
The political mandate
would be rein in inflation, even at the expense of asset prices.
I think that's a tough one there. I mean, I'm kind of 50-50 on that because so many Americans have 401k plans and so forth right now. And if the Fed were to take interest rates up to 6 or 7 or 8%, the stock market could easily lose half of its value.
I don't think the Fed has to take rates to 6 or 7 or 8%. I think the fact that the Fed is even talking about tightening, that the signal, the talking alone moves the market, and it has moved the market.
Well, here's the thing that I think is a key point to add to that, Bill. I don't think that the next few tightenings, whether they're 25 basis points or 0.5% at a clip, I think they're going to do very little with the inflationary problem. So I think the Fed is going to have to raise rates dramatically to do something about inflation, because I think that inflation, there are reasons why Fed policy is not going to do much about inflation.
Yep.
And that is things like the war, drought. You could blame that on climate change.
Well, the Fed itself, and this is, we posted this article this week on our page. The Fed itself has come out and said in a report by the Federal Reserve Bank of San Francisco that fiscal policy had a very big impact on the current levels of inflation. And it makes total sense. So when you're giving out free money, all the stimulus checks that the Fed gave out, or not the Fed, but Congress, okay, Congress authorized that money. That was inflationary.
Totally agree.
Okay.
And unfortunately,
and that's outside of the realm of the Federal Reserve. That was not monetary policy. That was Congress.
They're trying to do it again.
Yeah. So that's inflationary. And now, sadly, now we know that a lot of that money was used fraudulently.
Yeah, absolutely. That's and without means testing.
That's correct.
With that,
Trillions.
that's the problem. So much, a huge percentage of these monies that were targeted for specific areas did not go to the places where they needed to go.
It was used to buy consumer goods and cars. It was used to buy cryptos and meme stocks, and it was inflationary.
Yeah, cryptos and meme stocks. Well, what do we wanted to tap into? We've kind of run.
Okay, I want to kind of just piggyback on some of the things we were talking about. Namely, the Fed is raising the Fed funds rate, and the fact that the market is seeing the Fed funds going to about 2.4%. Currently, that's where the market sees it going. Well, it's making cash look very appealing. And, cash has really gotten a bad rap, over the last decade because it hasn't yielded anything. So, if you've had money in the bank in interest-bearing checking accounts or savings accounts, or you've had money in money market funds, you've just been earning nothing, a goose egg. Now, thankfully, we haven't had much in the way of inflation, but that changed. And so with inflation escalating, your cash is not only not making anything, you're actually losing money on a real basis, meaning after we account for inflation. So in nominal terms, your cash is preserving capital, but on a real basis, you're losing money. Well, okay, Jack, you pointed out correctly, the bond market is down about 6% year to date. The U.S. stock market is down about 5% today, year to date. Okay, well, let's say your cash is at 0. Well, that's better than -6 or -5, right? So for all the people out there bemoaning cash as being trash, because, you're losing money net of inflation. Well,
imagine owning bonds to earn a couple of percent over inflation, and you lose 6%
in a quarter,
and you just had 8% inflation year over year. So you lost 14% on a real basis.
That's it.
That means you're 14% behind where you were 12 months ago.
That's right.
Yeah.
And we had a meeting with a local organization this week discussing cash management strategy and proposal. And this is something that we really got into in a big way, kind of a niche that we developed years ago in the aftermath of the local Haynesville shale windfalls, that people were receiving. And we found that a lot of our clients who were participating in the Haynesville shale, were getting these big checks. They would go to the bank. The bank didn't want them. They would begrudgingly take it because, they have to reserve against that money, and they didn't need it for lending purposes. And so, these people weren't getting anything on their cash. So we came up with Creative Alternatives, a strategy that we developed where we could preserve capital, provide maximum liquidity, and do better than what someone could do just putting money in a bank. And it was a very effective strategy. I mean, if you go back to before the credit crisis, you can make 4% on a money market fund. Okay, basically no risk, maximum liquidity, money market fund, 4%. Well, obviously things changed when the Fed took the Fed funds rate down to zero in the aftermath of the credit crisis. Well, now we're seeing that pendulum swing back. And so now these cash management strategies are becoming more interesting. And every day, I mean, we're looking in the bond market, and we're finding to your corporate paper, investment grade, that's yielding 3% plus. I mean, the fact that a 2-year Treasury is yielding 2.4, I mean, that's higher than 2-year CD rates.
I bought a $250,000 U.S. Treasury this afternoon for a client that comes due July the 31st and yielded 2.11.
Nice.
Yeah, and
very nice.
Another thing to add to that is you don't have to pay state and local taxes
That's
on
right.
the interest from that.
And
so,
remember this, the dividend yield indicator. Okay, it wasn't that long ago. It was 2020 when we got to a point where the dividend yield on the S&P 500 exceeded the 10-year Treasury yield. And when that happens, that's a good sign for stocks, because generally when you see the dividend yield on the S&P 500 exceed the 10-year Treasury yield, the next 12 months are going to be good for stocks. That's just kind of a rule of thumb. And it played out. Well, now it's flipped. So the 10-year Treasury yield is at 2.4. The S&P 500 dividend yield is at 1.3. And that's a 20-year low on that dividend yield.
There's an interesting point. I think up until like 1958, stocks always out yielded the bond market.
Yeah.
And then we had, a big shift there. But it's interesting, I think, also to note that these two basic asset classes compete with one another for capital.
Mm-hmm.
And I don't think that 10-year treasuries are really there yet. When you compare that to the equities markets, I think it's going to take, if like in 1994, we had long-term treasuries go from 5.78% to 8.25% in about 90 days. That's something that's, much more palatable or investable, if you can earn those kinds of returns. So,
sure.
I mean, we're going to need to see treasuries go to 3 or 4 or 5% before. I think, how many times have you talked to a client that says, well, we're just not allocating into that space right now because there's no return there? I mean, I've heard that so much from people that buy oil and gas people that have traditionally put their money into tax-free municipal bonds, which historically yield a little bit less than treasuries because they're tax exempt. And we're going to need higher interest rates for the bond market to really compete, with stocks. And I agree. Let me ask you a question while you're doing that, Bill. So what part of the curve, I mean, does it make sense to you to own long dated bonds, or does it make sense to own, shorter dated bonds in this climate that we're in right now?
Well, I mean, for us and our clients, no, it does not make sense to own long dated bonds unless you're speculating on the direction of interest rates. Now, some people will do that and they can do it successfully. If you have a strong feeling that, interest rates are going to go lower from here, well, you can buy long dated bonds. You can buy an ETF comprised of long dated bonds, and you will get a levered return as interest rates move lower. But again, that's speculating. For our purposes, no, we would rather have shorter duration bonds.
I mean, if you think about it, the risk to reward ratio, this is one of the worst things ever in the history of America, where you have a 30-year treasury bond that yields 2.5%. If interest rates go up 1% on a 30-year treasury, you lose 20% of your money. So
but
I mean,
as you mentioned earlier, the 2 years at 2.4. So I'd rather be at the peak of the yield curve, to answer your question. And, that's really, we're looking at 2 to 3 years.
My feelings exactly. So that's where we feel like you don't have the volatility risk.
Right.
You've got the returns right there. I actually think that long-term bond yields are going to go way higher than where they are now. And that means, we're generally not going to allocate there because it doesn't make sense to invest in something paying 2 or 3% where you can lose as much money as you can in the stock market.
The only thing that will make that work, long dated bonds, is if we're heading into recession, long-term rates come down, and we do see flight to quality out of risk assets into bonds. But that's why you want to be nimble. You don't want to buy a 30-year bond to hold to maturity. The only people doing that are institutions. That have to do that.
The average. I recently read that the average holding period of a 30-year Treasury bond bill is 10 days.
Yeah.
So people do buy them. But if you had bought the inverse of a 20-year Treasury TBT, you've made 25% this year doing the opposite of that. So shorting the long run.
But I will say this: when you hear people poo-pooing a whole asset class, saying things like bonds are dead, that's a good time to step back and say, maybe I'll be contrarian on that, because we've heard that before with stocks. Stocks are dead. And when you hear that kind of sentiment, generally the opposite happens. So I wouldn't jump on any bandwagon, that will lament an entire asset class. But I will say this, because we're talking a lot about short-term yields and cash. With what we're seeing right now in both the stock and the bond markets, both under pressure, and we are seeing the stock and the bond market moving in a more correlated fashion. Okay, bonds and stocks do, over the long run, tend to move in a positively correlated fashion. It's really only been the last decade or so when we've seen the opposite, where stocks go down, bonds go up. So we're in a situation where stocks and bonds are moving lower, and both could continue to move lower. There's nothing wrong with having some cash, some dry powder, and we're moving into an environment where you can actually get paid on your dry powder.
Yeah, so that makes the case for talking about cash management.
Yes,
and
absolutely it does.
So I'd say that for anyone out there, we've got a meeting that we're trying to schedule next week. There's a client of ours that sits on a board of a credit union, and they're earning 0.5% or less on huge cash balances that they want some help with, putting to work. And I'd say that too, Bill, because I actually believe what you just said is something that's likely going to come to pass. And that's where, if the Fed tightens too much, you're going to see both bonds get creamed and stocks get creamed. So one answer to that, of course, our biggest answer is alternatives to stocks and bonds that are inversely correlated or have a low degree of positive
negatively correlated.
Don't negatively correlated. True. Thank you. And even adjustable rate bonds that will where the payout goes up if interest rates go up. So I would say, if any of our viewers if you've got a lot of money in the bank, earning. Typically, right now, the banks are very, very slow.
Yes, I was going to say that
to raise their payments on cash balances for savings accounts and checking account. I think I'm getting 0.06 or something on my checking account.
I'm looking. Okay. Here's average national CD rates. 6-month average CD rate, 0.75%. By comparison, a 6-month Treasury yields 1.13. A
Yeah.
1-year CD on average, 1.25. 1-year Treasury over 2.
Yeah.
Yeah.
Wow.
That tells you.
Yeah, we've got our friend who he won't stop texting me, even though
He should
I
be
told
watching
him
the show.
he should be watching the show. And he sat in your chair a few weeks ago, and he's
But we're not uncovering anyone.
no.
He's texting me. He's texting me too.
Is he? So he's looking at this is something that I would tell him, and I did tell him that. Look, hey, do you know what interest rate I got on my house that I bought? And this is,
Did you get sub 3?
I got 2 5/16.
That's amazing.
I have never. No, I was about to say I've never heard of anyone getting a rate that low, but I did hear of someone who got a 15-year at 1.9, and at 2 5/16, I want to finance as much as I possibly can. But you know the average yield today, Bill. I did this in late December. The average 30-year mortgage rate right now is something like 4.6 or 4.7, and if you're out there thinking about swapping your house, so there's a trade-off here. It is a seller's market. Huge appreciation with this inflation thing, with housing in the last year. If you can sell your house for a whole lot more, but the trade-off is you likely are going to be, if you finance it, you're going to be financing it, at a higher rate. But I think now's the time to do that if you're on the fence, because I think interest rates are in fact going to go higher from here.
Yeah, I mean, as these 30-year mortgage rates keep going higher, I mean, that's just going to pop a potential housing bubble here.
No question. That there's a very, very significant probability that that's on the horizon. Wouldn't you agree?
Yeah. I say
What
we
else?
wrap it up.
We wrap it up. Well,
Unless Wesley has something to add.
we've got to throw in the sports.
Do we?
We do?
There's sports.
March Madness, Bill.
Yeah.
What
Miami Open.
Who-
Tennis.
I watched the Miami Open last night.
Great match.
That's how
And,
I fell asleep.
I watched this. I was awakened to this 18-year-old kid.
Alcaraz.
Alcaraz. Have you ever watched him play before?
I watched him last night. That was one of the best matches I've seen.
He came behind in the in the tiebreaker. He was down 5-3 and came back to win that thing 7-5. And the other gentleman, that he has to have left with a sickness in his gut, because he was one shot away from game over.
He had 2 match points.
And
Alcaraz, he's a phenom.
it's so it's Kansas, Duke, North Carolina, and Villanova. And I'll give you a certainty, if you're a betting man, that a team that's wearing blue is going to win the whole thing. Okay. But we've got a classic matchup. That's the Final Four. Kansas against Villanova. And what I really like about that, Kansas, no one in the media is really giving Kansas any credit. And I think it's because where Kansas is located. It's kind of dull and boring. It's in Kansas. That's correct. You don't have the Northeast or the East Coast or the Los Angeles, Times people writing about Kansas. They've got, I don't even know what the Kansas newspapers are, but anyway, they just came right through, and but they're playing a Villanova team that's leading the nation in free throw shooting, 82.6%. So, and then you've got Krzyzewski, the longtime coach at Duke. This is his swan song, and he's playing huge, biggest rivalry. North Carolina, which is an 8 seed, in the Final Four. They've never met in the NCAA tournament before.
Really?
They never have.
Huh.
They never have. And I'll tell you what was fascinating though, to end this is I heard these kids talking, and I wouldn't encourage anyone to start doing this. I am one who does not. I know some people who've been addicted to gambling or gaming, but there was a 15 seed called, do you know who the Peacocks are? No, St. Peter's College. Do you know where they're located?
St. Peter's Peacocks.
The St. Peter's Peacocks.
Do tell.
They were the
No.
15th seed, and they made it, first time ever, they made it to the Elite Eight. And they knocked off some powerhouses along the way. So they had
And where are they from?
New Jersey.
Figures.
And I bet you couldn't name another team in their conference either. So, or probably recognize at least half of them. Bunch of no names. Anyway, they put it together. That's what I like about basketball. With, you play a really good team game and you make your shots, and the sky's the limit. But they ran into a buzzsaw when they played North Carolina, and North Carolina pretty much doubled the score on them. But there's this kid that we know that Caesars and 6 or 7 other ones with the Halle Berry, Caesars commercials, they have infiltrated the law, and it's been legalized in Louisiana. I think Caesars is in something like 22 states with sports game. And I didn't even know this. We know this kid downtown who said, "Hey, the Peacocks are playing in 10 minutes. Let's run over to the casino and put $20 on the game." And they turned it into $157 as they won and advanced to the Elite Eight. But anyway, there you have it. The Final Four and the Miami Open in tennis. A couple of sports things if you've got the TV on this weekend. And Bill, thank you for coming back to work after an absence and knee surgery. And I guess we'll see you next Friday.
Yeah. Well, Wesley threatened to quit if I didn't come back.
Okay.
All right. That's a wrap. Thank you for watching. See you next week.